question, Austin, I had is managing positions when both strike prices have been breached, but you still have plenty of time. So like say, for example, I'm in the 371 QQQ. I think you're in that as well.
Yeah.
So like we're sitting at 373, 374 today. And we still have until August 18th, right? So what if happens if later this week, after some economic data comes out on Thursday, Friday, we dip into the high 360s? Um, like what's your personal like thoughts about how far are you willing to let it go down based on how much time is left to expiration before you kind of like start to get a little concerned?
Yeah. So I'll show you the data, and then I'll show you why I have the rules based on it. So if we're
Okay.
looking at QQQ, these are true triple strategies that we are looking at. So we're looking at roughly a 90% win rate at around, I guess, a 27% annualized return. Okay, so
Mm-hmm.
90 and 27 is what we're looking at. This is if we hold until expiration day and let it expire worthless or expire in the money for max loss. So that is
Okay.
what we're looking at in this scenario. If we come in here into our profile settings, and anybody has access to this, you can change the risk management preference to exit when it breaks below your strike price. So when it breaks below your strike price, we can also see the data on that. So we come over here to Qs again, let it refresh with the new settings. Go over here to the QQQ Pearl strategy. So we were looking at a 90% win rate at a 27% annualized return. Now we're looking at a 75% win rate with a 7% annualized return. Does it still work? Yes, it does. But it doesn't work out as well. The reason being is because these trades tend to break our strike prices a decent amount of times, or can. It's roughly 30% range will it break.
Okay.
Like 30% of the times our trade will break below that price. But a high percentage of those times that it breaks below, it comes back because we're trading with the trend and it dips. So if you want to sell when it breaks your strike price, you can do that. Here's the data for it. But again, I found, well, obviously the statistics work out better if I just hold until expiration day. Yes, that means I have larger losses for sure. You definitely have a lot of smaller losses here with this approach. But if you hold until expiration, you will have larger losses. But in the long run, it works out better because you have a higher win rate.
I see. Okay, that's fair enough.
In this table, I see something